Welcome to Know Your Options, the Measured Risk Podcast.
The ultimate guide to navigating the volatile nature of the markets while managing risk purposefully.
Join us as we challenge the theory behind traditional asset allocation and dive into the mathematics of investing.
Whether you are a seasoned investor or just starting out,
this podcast offers valuable insights and practical advice to help you make informed decisions and manage your money wisely.
So grab a cup of coffee, sit back, and let's dive into the world of calculated risks together.
All right, well, this is the Know Your Options podcast. I'm Larry Kriesmer. I'm here with my partner, Bernard Surofsky, and our guest today is Doug Herring. He's with Money Concepts, a big national firm, and we're here to chat today about Doug and his practice and how he's gotten into the business and learn more about it. So welcome to the show, Doug.
Thanks. I appreciate it, both of you.
Yeah, so let's start out with just a little background on how you got into financial services as an advisor.
Right. Well, thanks. It's a really good question for me because I spent about 40 years as a DIY investor back in the days when the only way you could get information is, having subscriptions to almost every,
Right.
magazine or journal out there. And then about 3 years ago, I was in accounting and finance, mostly corporate accounting and finance, budgeting, long-term forecasting, fractional CFO work, and had a little cancer scare a few years ago, decided to pursue my passion. I've always loved helping either coworkers or family members or colleagues, think about retirement planning or, how to buy a house and financing and all those kinds of things, and decided to put it into practice. So got licensed Series 65 and Series 7 and a few other letters behind my name and kind of went from there.
Yeah, I saw on the the broker check that, if anybody's familiar with that, everybody in the business is familiar with this.
Right,
Yeah, I saw that you've been licensed relatively recently, and so it makes sense that you've been in some sort of advisory capacity in your role as a CPA.
Yeah, and then I've had insurance licenses for about 7 years, so
I see.
Doing
Okay.
some life and using that in different ways. But
Right, starting there. So what was the first? I mean, I know Bernard, I think you were 17 or something when you bought your first stock. Is that?
Yeah, I was actually 13.
13.
Yeah.
Okay.
yeah, there you go. All I wanted.
I was a little bit later to the game, but
Early baptism.
But how about you, Doug? When did you first start doing investing on your own?
Well, the first thing that I remember is back when I was about 18, I got my first sort of real job. It was part-time while I was in college, but it was with a large corporation. And so they had, various investment options as part of the retirement plan. And so that's when I kind of, as an accounting geek, and I like that term, so I use it affectionately, but,
Yeah.
I had taken some finance classes, but, not enough to really feel like I was doing knew what I was doing. So started looking at the market, investigating the market, because I think maybe it's the nature of being an accountant. Protection was my first priority. But as an 18-year-old, I quickly realized that, if you're investing in, of course, interest rates in the early 80s were sky high. But, I quickly realized that investing in money markets at age 18 wasn't very smart. And so I needed to start doing some homework. And that's kind of how it all started.
Yeah, interesting. My first, I don't think I've ever shared this with you, Bernard, but my first investment, I was actually doing outbound calls for a Dean Witter advisor and opened up the money that I was earning and bought a mutual fund, paid my 5.75% front end load,
Mm-hmm.
and then promptly as a young kid needed the money about 4 weeks later,
Yeah.
and got my first taste of a CDSC, or deferred sales charge. So that was my getting my introduction to investing was a little different. But
I think your experience is probably better than mine.
I do remember one other story, if you don't mind. I do remember because I remember my dad introduced me to his broker. So now that you talk about paying commissions on your, initial purchases, which of course is unheard of these days, pretty much. Yeah, my dad's broker recommended I put a few $1,000s in Ford back in, I think again it was like 1978 or something like that. So I don't remember if that was before or after I was 18. I think after though. So that was my first actual stock purchase.
yeah,
And that is not a recommendation to buy Ford.
Yeah. Well, it's funny how we all remember our first stock. Mine was a gold mine, and it ended up not so well. That was a good baptism. Okay. It was a good learning curve.
Well, I think even Fenway would say it would be a good thing if you go back to 1978 and buy a couple of shares of Ford.
Yeah.
That wouldn't hurt. Yeah. So the past is the past. We can't go back we can't go back and rewrite that. So let's talk a little bit about, do you have any mentors or any people or, things that you've used to go along the way to come up with recommendations about, how you put together portfolios for clients?
Yeah. So, in terms of mentors, interesting enough, I guess it wasn't my very first boss, but my very first boss in sort of more of a corporate financial planning role was a PhD in economics from Colorado School of Mines. And he had got his PhD when he was like 22 or 23 years old. So he's relatively smart guy, recently retired from Comcast, is one of the top, I don't know how much of this I should say actually, but as one of the top sort of 20 executives in the corporation. So, relatively bright guy. And so he and I used to get in early and chat almost every morning. The other piece of that is, as a boss, he always had subscriptions to just about every financial journal out there, and he would pass them around the office. We had a team of about 5 financial planners. So that was my first mentor. And of course, I think I was 23 or 24 when I took that job. So relatively early in my investment, thinking. In terms of after that, I don't know that I had any real true mentors after that. Currently at Money Concepts, I'm working with a team of people where I think 20 years is the minimum the rest of the people on my team have. So they're all, even though I know a lot, they're all mentors in terms of if I have difficult cases or something odd comes up, they know just what to do, or at least they have good advice of where to get started, but a lot of what happened, I think I left that position with that gentleman I talked about when I was about 30 years old, plus or minus. And really after that, I had been with him for, plus or minus 6 years. And I think I learned a lot. And I read just everything I could get my hands on. And I think that was the start. And then just, again, trying to keep up periodically after that. I think one of the things he taught me, which we all should do, is just continuously read, continuously research, because things change and markets change. And of course, I don't know that a lot prepared us for 2000 and 2008, but, yeah.
Yeah. Well, we started this conversation with the idea that you kind of knew about protection. Why don't you talk about that a little bit more? What do you mean by that? Or what's important about protection? Or I don't know, maybe I don't want to put words in your mouth, so I'll just leave it at that.
No, yeah, we could go a long time talking about protection, right? Because we could talk about insurance products and things that people ought to have in their life, which people don't always think about as part of their investment life. And I guess it's not part of their investment life, but it is part of their financial life, right? So just basic things like life insurance and other types of insurance to protect against, big losses that could be catastrophic and make your investing success kind of go away. But no, what I meant was, when I first started investing, like I mentioned money market, funds and things like that. I was really big on like, oh gosh, I've got to make sure this money's, in U.S. government securities. And again, like I said, at that age, I realized, pretty quickly, fortunately within a few months, that was not the right way to think about protecting my assets as an 18 or 20-year-old, because obviously that can completely limits the upside, right? So pretty soon after that, just thinking about asset allocation and what's appropriate. And of course, traditionally, right, we think cash, bonds, stocks, right? That's you read most stuff and that's what people talk about. But and especially as the mutual fund industry changed, all of a sudden you've got access to a little bit of real estate markets or potentially, hard assets or commodities in mutual funds and things like that. So I guess, diversification is not a perfect solution to protection, obviously, but, at least a little bit of protection on the downside when the stock market, stops or, drops. And I think the other thing that I'd say about protection, especially today, is, you mentioned that you all work with options models. I mean, there's ETFs and funds out there that do maybe similar to what you all do, maybe not exactly the same way, but in that, even more and more, I start thinking about things like annuities, especially as I get more and more of this white hair, that lifetime, lifetime income protection. So that may be too long of an answer, but there's a lot.
Bernard, why don't you delve into the idea, because we have some pretty, let's say, outside the box thinking on diversification and asset allocation. So, Bernard,
I think it's interesting, because you were mentioning the list of various assets, and you mentioned, stocks and bonds and real estate and what have you. But I always marvel at the fact that people don't generally include options in the word asset allocation. It seems to be like the one asset class which I personally believe is the most predictable in how it's going to behave when you expect it to behave the way you want it to behave. Meaning, an option will go to the value you expect it to go to if you know what the underlying is going to do. Do you have any thoughts about why there's not more kind of understanding of using that type of asset more broadly? Or do you have any thoughts on that?
Yeah, I have. This may say some negative things about the advising profession, but I think, my opinion is that, there's a large investment company who has said that the licensing exams are too difficult. I think in some ways it may be just the opposite. And so the short answer to your question, I think a lot of advisors really don't understand math. I'm a math geek. So, I'm not an expert in options in any way, but I understand the math behind it. I understand the concepts. I think there's a lot of advisors that just, maybe they understand it a little bit conceptually, but maybe it scares them. So I think that's probably part of it.
Yeah, I think my experience, I got my Series 7, I don't remember now, 1992 or 3.
Right.
It's been many, many years ago. And I remember pretty clearly, though, that it felt like 30 to 40% of the exam was options driven. And you've just recently taken the Series 7, right?
Yeah, I don't remember exactly, but it was earlier this year, right?
Yeah, right. So, it's real. And is that still the case? Is it pretty option heavy?
It's still pretty heavy into options. And
so here's what was fascinating for me. I think what was fascinating for me is that, okay, I was with a big insurance firm at that point. That's where I was being brought up into the business. And I passed the exam. It's all heavy options. I'm kind of interested in how this would work and how to apply it to the practice. And I'm basically told by my supervisor, no, we don't really do options here. Yeah. We don't really want to do that. So I think it does kind of just boil down to some sort of impression or thought by the supervisory, the risk and control group, that options are maybe too spicy or too dicey.
Well, to your point, Doug, that you made earlier, which is, the education, we were with a firm, where the supervisor couldn't actually get to pass. One of the challenges we had was that our supervisor didn't quite understand the options thing himself. And so it became something where, we were precluded from using them because our supervisor couldn't
pass the exam.
Couldn't pass the options principle exam. The options principle. So I was like, so we weren't allowed to use them. And we're like, come on.
Well, I think to your point, that's a good point. And I do think it maybe, I don't know if it confirms my suspicion or not, but I just think, in general, let's just admit it, Americans just aren't very good at math as a population. And so options take math, right? You have to not only understand the underlying asset, that takes a lot of analysis. Well, you would know better than I how much analysis it takes, but, you have to understand the underlying asset. Let's just say we're only trading options and stocks for now. You have to understand, obviously, something about that stock and where it's going, whether that's technical analysis or just looking at the business and understanding, that sort of more of a business analysis. But,
let me step back from that for just a minute.
You got to pick a strike price, it gets, and I think, I don't envy you in the sense that, your clients somehow they either have to really trust you, right? Because it's unlikely your clients understand options too well, or you have to do a lot of education into this is why we do what we do. This is how it works. This is how we choose thing. I mean, I'm guessing you don't have to explain every single transaction you do. That would be untenable.
No.
But
yeah, exactly. Well, I think what's interesting maybe in the option space is that let's just step back and think about just traditional portfolio construction, because we are we're trained on it.
What does Doug do in terms of the portfolio? Doug, tell us a little bit about how you build a portfolio for someone. I walk in as Mr. Prospect or Mr.
Right. We'll take a traditional 50-year-old person, $500,000 portfolio, $150,000 income, saving, maximum in the 401k plan.
Sure.
Reasonably, moderately to moderately aggressive risk tolerance at this stage in his life. What does that look like to you?
And I think at a 50-year-old, that's a great example, right? Because they're within that, what I would say, depending on when they plan to retire or if they plan to retire, makes a difference for me and how I would, suggest they build that portfolio, right? Because if they plan on working till they're 75, like, people that enjoy what they do, and in our field, I know people in that category.
Yeah.
Or if they're planning on retiring early at 60, so time horizon makes a big difference to me, right? Because volatility in the stock market goes two ways, right? And so the longer you have, the better chances you are of the volatility helping you on the upside. But the shorter your time horizon, the higher the probability that a downturn, just something like sequence of returns risk. So somebody's doing their constant 4% withdrawal. So, that's the first thing I do is I would talk to the client, determine their, how much risk do they really want to take? How much flexibility do they have in their retirement date? But in terms of, what we talked about earlier is downside protection. I don't personally trade options. I don't feel I'm as competent as I would like to be. So if somebody needs that kind of protection, we usually look at, as long as they're comfortable with it, things like hedged or buffer ETFs, which, and as you know, a lot of buffered ETFs, how do they buffer? Well, they're options traders, right? For the most part. And so they're probably doing something very similar to what you're doing, I'm guessing, because as you said, options are relatively predictable. And if you know what you're doing, and, that's part of the way they can not necessarily guarantee, but, set a buffer at, let's say, 10% downside is with a certain amount of accuracy, they know that they can trade options in such a way that, that they can, like I said, not guarantee, but at least put that as a standard in a,
target. I think target might be a bit.
Exactly.
Yeah.
Well, I think let's talk about if we have, do you do a lot of individual stock selection or is it more ETFs?
I don't like to. I actually, so the funny thing is I do a lot of individual stock selection for myself, but that's largely due to my financial position and kind of, anyway, my financial situation. I don't really feel comfortable picking individual stocks for clients just because I don't, if they have that appetite, then, we'll discuss it, but I'm not Warren Buffett. I don't pretend to be Warren Buffett. I feel like I, understand enough about stock picking to pick stocks for myself, but I don't know that I also don't have the track record that he does. So
what does a standard recommendation, not cookie cutter necessarily, but what are your go-to arrows in your quiver when you look at an allocation for a client? There's a couple funds that I like, and I won't name them exactly, but give me broad asset classes.
Yeah, so there's a fund that I like. There's an ETF that I like. It's actually, they're both by the same company, and they're bond and stock sector rotation funds. So you basically leave it to the asset manager to, how they work. But for anybody listening that might not, so let's say in the bond market, they might, have long-term bonds, high yield bonds, short-term bonds, and then they increase or decrease the percentage of assets based on what they think interest rates are going to do or what the bond market in general is going to do. So I like that a bit. I think they've, for the most part, shown that they can do better than just picking an aggregate bond fund. Those funds don't have a lot of history, so I could be wrong in the long run. I hope not. But the concept makes sense to me. And then for some people, especially younger people, a lot of the asset allocation is a high percentage. A lot of times if they have the risk tolerance for it, it's 100%, stock ETFs. And sometimes it's as simple of a portfolio as, 80% in an S&P 500 ETF and, another 10 or 20% in something like a NASDAQ ETF if they, or maybe Russell 2000 if they want to, go small stock, but something like that, for older, people more my age, it might be more, sort of a mix of buffered ETFs, some stock ETFs, and then, one of those bond ETFs, something like that. And then generally I do try to recommend at least a certain percentage being, something like a real estate ETF or I haven't experimented with covered call ETFs yet, but I think using the buffered ETFs kind of gives a flavor of at least, again, that downside protection with still at least a partial participation on the upside with the S&P 500. The one challenge I will note that I've had with clients is with something like a buffered ETF is they love the fact that they have a buffer on the bottom end, but if the market goes up, they're always complaining about why didn't, the market went up 30%. I only got 16. And it's like,
Well, our approach here, just to sort of set the table, is in the namesake measured risk portfolios, our firm. We feel the same way. We want to be equity investors to get the opportunity. We don't have any assurance or any guarantee that the market's going to deliver any kind of strong returns. We just have to go on historical evidence that that's how it arrives. It doesn't come at 8% per year or 10% per year, whatever long-term average you're looking at for a long period of time. It comes in spits and furts, and it goes in basically 18 or 23 or 31, and then it loses 50% of its value or, something like that. So what we have observed is that you've got this engine that pistons up and down, and it seems to take a lot longer to piston up than it does to piston down, right? And so the losses when they come are not necessarily frequent, but they can be severe. And they're only as bad as they've been. It doesn't mean that they couldn't be worse. And that's one of the things that keeps us up at night is, well, how bad do you think a stock market sell-off could be? Just because we had let's say a 50-something% decline during the 2008 debacle doesn't mean we can't get a new debacle that hits new lows and we lose 63% of the equity value. It's just, there's nothing stopping that from happening. So that's always been kind of our backdrop. And the part that made us look for something else, and we couldn't find it, so we built it, was the idea that even it's a 60-40 portfolio where 60% of the client's portfolio is in equities, if the market part, the equity part can drop 50%, you do the math, 60% of 50%, it's still going to bring your overall portfolio down 30%.
That's assuming that the bonds don't lose anything either.
Yeah, that's assuming that the 40% that you own, it holds on to its value. Now, if it makes money during that period of time, then it's a win and it offsets the 30%. And again, Bernard and I took this sort of idea that we were actually building portfolios very much like you're describing back in the 2000s, early 2000s. And we used optimization software that put it onto the efficient frontier and trying to maximize what the rate of return is with the least amount of volatility. And these work great. They really do work well if you have assets that are going up and down independently of each other, that you can always harvest and sell high, take those gains and buy the things that are currently depressed in value that you have an expectation they'll come back and go up in value, and then you'll sell them and harvest gains and put them back into the cycling positions up and down. That's the basis for this. But our kind of critical observation is that this normalized returns that are happening under, let's say, normal market conditions can become really uncorrelated and can suddenly go to one, so that the things you bought that you thought were independently moving all start to decline at the same time, just maybe with a different speed to the downside. So that's the part that we're really frustrated with, because when we have a client call in, they usually were calling in because they've already exceeded their loss threshold. You know, that's whatever market event was happening is beyond what we thought could happen to their portfolio. And so they're calling in concerned and want to know, well, how much more do you think it's going to go down? Right. And it was literally, Bernard, just debilitating to not have a solid answer, you know, because really all we're able to do is go back and say, gosh, well, historically, these portfolios that we built haven't declined more than this. And now we're blazing new ground. We're hitting some new numbers, and we just hope it won't be any worse than where we are now. And that, honestly, that's just not very confident, inspiring. And that's what kind of got our eyeballs looking at options. And I think if you, as an industry, if we don't focus on what options can do, then all we have left is asset allocation. I think that's the big aha moment for us, is that once we have a new tool, maybe we can solve the problem a little differently. Yeah. Or at least come at it with a different set of solutions.
How do you address the concern? Like if you have a client who comes in, like, let's talk about March, February, March, April time of this year, even where the markets were kind of having how do you address those concerns? Or did you find that your clients were already well prepared for that type of behavior and you didn't get inundated with calls? I mean, how did that go? How did that work out?
March of 2023, right?
Yes, correct.
Yes. I actually didn't have anyone concerned about March of 2023. Most of the people I know are still talking about 2022. And the fact that, as you said, I mean, this, is the perfect storm, really, right? Because stocks drop as much, well, depending on what dates you're using, plus or minus 26%, and bonds, an aggregate bond fund on average was down 10 or 11% at least at some annual point in time. So, even if you had a 60-40 portfolio or flipped it and did a 40-60 because you were trying to be a little more conservative, it still didn't, you still lost 15% or something. I'm having trouble doing weighted averages in my head and talk at the same time, but
that's fine.
But
you're on track.
Something like 15%. So I know the best. I won't use that example because it's a family example, but I have people still complaining about 2022, and I think fortunately, because of the use, at least with older folks, because of using something like a buffered ETF rather than just a straight S&P 500, ETF, indexed ETF, they didn't lose the 26% or whatever. Now, because I don't usually use a lot of just aggregate bond funds with knowing that interest rates will be increasing, I tended to go a little more short term. Now they still lost money, but not nearly as much as, say a longer term bond fund, although with the yield curve with the yield curve inverting there for a while, that was a little bit interesting. But like I said, 2023 hasn't been a problem, but I think your point about, does apply to 2022, right? I mean, something besides a bond stock allocation has to be in the mix. And so gold, surprisingly, right, gold didn't help us really at all with inflation. And, normally you would think, oh, precious metals, inflation, perfect. Nope.
Right. Yeah, I've said many a time, gold should be trading at about $5,000 an ounce if it were
to have been any meaningful return.
Yeah, to have actually done what we expected to do in the environments where it should have done. Part of our impetus when we built what we built was we played out the hypothetical scenario of what did we think was the worst thing that could happen, and we kind of came up with this idea of and heavens forbid this should ever happen, but a nuclear explosion in a Western city, and we were like, well, that's going to be a bad day. Should that ever, heavens forbid, happen? And, we didn't realize that what we built was actually, pandemic proof.
And Great Recession.
And Great Recession proof. And it wasn't even intended.
Yeah, the idea, and we haven't really talked about what we do. We've talked about, maybe why. And the why really is that we wanted something that wouldn't require Bernard and I to be able to do research, glean information, extract a position, and then deploy capital in a way that was going to benefit from us being correct. What we wanted to do was build something defensive that if things went terribly wrong, we had a firm grip on what the losses would be. But if things went well, we participated fully, or at least to a measured extent, based on client risk tolerance as to what that upside might future come. And so we've adopted the idea that we're completely agnostic as to market macros. If you asked me in February, let's say March of 2020, when we're just in the thick of the initial part of the pandemic starting, and the market had declined like 28% in 17 trading days or something.
Right.
Should we go to cash? My brain would say, absolutely. Let's say that's not true. My heart would say, absolutely, right? My passion would tell me, get the hell out of Dodge. But my brain told me, no. We've already prepared for this. We've got the positions in place. We don't have to do a thing except just sit. And that's exactly what panned out and worked out really well for us. So the why of what we built this for is so that clients don't ever have to call us and be in a concerned place. They should know going into the future that if things don't pan out well, we've all agreed as to how bad it's going to be for them. And we don't want it to somehow turn left and go onto a dark alley we didn't expect to get going down, and then get ourselves beat up down that dark alley. So that was really the formative thing for us. Now, it turns out the how is actually remarkably easy. And this is the part that makes us kind of frustrated, that you don't have to be an option geek or even a quant person, but you do have to know a little bit of math. And so the math part is this. We've taken, instead of shopping around for a bunch of different asset allocation pieces that are hopefully going independently, moving up and down, we literally just tossed it out and said, okay, what if we put, just for argument's sake, 90% of a client's portfolio into treasuries, short duration treasuries? That thing that back to when you were 18 years old, you can't succeed with that long term, right? If we're going to try and get a market-based return with the 10%, that's our risk capital. We can't just invest it in stocks, because stocks won't return enough.
No,
there won't be enough return. So what can we do? What else is there? Well, and it turns out it's options. If we take a small allocation, relatively small allocation, actually relatively large when you consider, what other people might consider a use of options, but a relatively small relative to the portfolio allocation to options. And we don't pick individual stocks. We just, use it as an index like the S&P 500. And we have that historical evidence that tells us that the markets go up more than they go down. And we basically just attach our options to that engine. Then here's what we know going in. We can lose 100% of our option allocation if the market doesn't do what we want it to do. But that's all we can lose, is whatever we've spent on the option. And there's no other component. Again, if we take the idea that the treasuries are likely to be able to pay off, let's say highly likely, but not guaranteed. I mean, they're guaranteed by the U.S. government, which is, still potentially fallible. But if we get into a situation where the U.S. government can't pay back its short-term debt, we are all in.
That's right. So, that's kind of my mantra. It has been for a long, long time. But
I wouldn't have a lot of faith in what the value of Tesla would be if the U.S. Treasury is not able to pay off their bonds. So, no offense, Elon, but just saying, even any other stock for that matter. So that's the idea. And then if you consider that. The idea of measuring that risk, if we want to put 5% of the portfolio into options and 95% in treasuries, or 10% into options and 90% into treasuries, or 85 in treasuries and 15 in options, you can dial up or down the amount of relative and known risk that a client's going to take. And each incremental amount that you put additional into options just increases the engine, the horsepower for the potential performance. That's it in a nutshell. And we don't have to be a quantity person to understand that if the market goes up, you'll get your treasury return plus some return from the options. The market goes down, you'll get your treasury return and you'll lose the options. That's that. And with that structure, you can have an uncapped exposure to the markets. Now, again, participation rates will vary based on how much risk you're prepared to take. but it's very understandable. At least that we think it is. So that's kind of our what do you say, Bernard? Our mission, mantra is to just get this idea out there.
Just educate people.
That there's another way to look at this opportunity to structure a portfolio. So
it's just that it's the mathematics of it. If 10% of your portfolio can make 100% for sake of discussion, then it means that your overall portfolio will be up 10%. And if the 90%, that's assuming the 90% does zero. And if the 90% does anything, that's just going to be on top of. So that's the basic premise of the mathematics of it.
Sure.
And then just a brief, thought about the buffered ETFs and those kind of things. Now, the buffers, anyway, the ones that I'm familiar with have a 10, 15, 20, even 30%. Let's say you skip the losses. So if the market is down 10%, you have a 10% buffer, your loss is zero. The challenge I find with that is that if you've bought your 10% buffer and the market is headed down past 37% losses, well, now you're in for 27% loss, again, with no bottom in sight. And so you've kind of skipped the first 10, but not necessarily solved the problem of a client bailing out of a strategy or a plan.
Mm-hmm.
And even if you've done a bigger number, like a 30% buffer, and the market you've obviously got a person in that who's very risk averse. And if you've breached that 30% buffer and you're headed down 37%, let's say, well, that person's going to come unglued too, because they're not even prepared for the 7% loss.
Right.
But in exchange for that, they've capped what they can earn, because the 30% buffer is going to come with a very modest cap in what they can earn going on the front end. So if we switch it around and say, okay, let's prepare to take the first losses, and realize that you can't be an equity investor without being prepared to have some kind of loss or some volatility in your portfolio. But we can participate in the first part of the loss, but not the big part, the unknown part. Scary. That's what you try to put a damper.
Yeah. No, it's an interesting concept. I'll be honest, I don't know anybody else that's doing it exactly that way. I mean, I do know some people that do options trading, but I don't, that, especially talking about a 90-10. I know I'd love to know more. I'm sure.
Yeah. Well, we can certainly talk offline, and that's what we're out here doing, basically, Doug, is just having conversations with advisors. And we understand that we don't expect you to go to option school. You're welcome to. Again, we've just given you the recipe. It is. And in our minds, if more advisors
like
pick it up and
something
use
I
it,
need to at least investigate more, and because if you can do. I'll just say this, not necessarily even as an advertisement. So just for listeners, I'm not being paid to say this, but it sounds like, if you've really figured that out, it just sounds like a really good system that at least for me as an advisor, I'd say is worth me knowing more about.
Yeah. Okay. Well, I appreciate that very much. That's basically our wish, is that more advisors look into these kind of things. I think we're getting a lot of money going into buffered ETFs, and it's got an interesting appeal, but it's still going to end up at the end if things get again. Bernard and I are not concerned about a 15% sell off or a 9% sell off. That's really kind of, you have to be prepared for that from a volatility perspective. But we're really concerned about a 42% sell off, and the math of gains and losses does not favor the losses, because if you're a math geek, you know that 10% decline takes 11% to recover. Right. 50% decline takes 100% return to recover. Right. So you just can't let those holes get that big. And we're also bullish, long term. We're bullish. We know we're going to recover from a 50% loss, but it might take 5 years, or longer, and you're just never going to get that time back. And so if we can keep clients at a level where the losses are manageable or measured, then we have a better chance of getting forward outcomes. So, I think we've spent quite a good time here, kind of uncovering your experience with investing and our kind of approach to this.
Was there anything that you wanted to add that we haven't asked you about?
No, I don't think so. It's nothing about me. I just, in some ways, I'd love to know more about what you all do, but I think if I started asking questions, we'd add too much to the time. So, we either have to do something offline or something like that. So that's your choice.
Well, Doug, thanks so much for joining us today. And we'll circle back around and answer any questions we can and see if we can help you.
All right. Well, thank you so much for having me. I really appreciate it. It's good meeting you all. Thanks.
You too.
This interview also may contain statements that constitute endorsements of measured risk portfolios, also known as MRP. Please note that any such statements are not made by clients of MRP, but by representatives of other investment advisory firms that work with MRP. No compensation was offered or given in exchange for these statements. However, a conflict of interest exists due to the incentive to give an endorsement in the interest of a good future working relationship between the endorser and MRP.